Good afternoon, viewers, and welcome back to my channel. Now, as you know, BFSI and digitalization in BFSI has been one of the most important themes of this channel. And in the last few posts, I have been talking about how India is rapidly digitizing itself as a country. And therefore, today I am going to bring to you the contents of Niti Aayog's paper, which was published in July 2022, on the framework that needs to be adopted for full stack digital banks. Now, let me just step back and talk about the context of this. You see, as we grow as a country, our credit needs and meeting the credit needs of the micro and small enterprises is integral to our ability to fuel growth. Now, the way, if you look at a couple of data points, 33% of credit is today addressed by the classical banking model, which means there is a huge headroom which the credit staff population of India needs to be engaged with. That's one. And the second is that the addressable credit gap of micro enterprises is growing at a rate of 37% annually, 37% CAGR as outlined by IFC. Now, which is a huge credit gap, and we need to therefore bring the micro enterprises into the formal credit system and not to leave them to the mercy of the village money lenders and so on and so forth, or the informal system. Now, the question therefore is that while there has been structural reform from the Nachiket More committee and the last few years, has it been adequate to meet the credit gap? Obviously, the data says no, and therefore there is a need to create full stack digital banks, or banks who would be able to lend to these unbanked and underserved population more effectively than the classical analog banking structure. The question is, what is the framework that is going to be most effective? How do we do it? And therefore, what are the limitations of the current model, which is what I'm going to discuss in this video. So stay tuned at the end, and people who like the content, do share it as you deem fit. With that, let's move to the presentation, which is full stack digital banks in India. Now, let me start by talking about the inclusion context, the financial inclusion context. We all know that the Jan Dhan Aadhaar mobile, the JAM Trinity, has led to significant improvements in financial inclusion. A lot of people have been now brought to the formal banking structure, but financial deepening continues to be a challenge. As I said, the addressable credit gap of MSMEs is 25.8 trillion, growing at 37% CAGR. And therefore, even after the Nachiket More committee set out small finance banks, which were actually created to give credit to micro MSMEs, and 50% of the portfolio less than 25 lakhs and 75% in priority lending sectors, also the inclusion of payment banks into the whole architecture, where they could issue deposits and offer payment services, still the credit gap has not been met. The other important point is that the banking license, banking being a regulated industry, the banking license actually enables incumbents to access low cost funds, and their cost of funds is 7.5 low cost funds, which actually the cost of funds comes down to 3.8%, where for others who do not have the banking license is 7.5. The difference is the banking license premium. Now, should this premium or the strategic mode coming out of the license be continued forever? It's an important question. And therefore, what are the steps that the regulatory environment should necessarily take to bring the MSMEs into the formal credit net, and how should it be done? There should be what kind of product innovation should happen, what kind of distribution models, and therefore the technology behind it that needs to be built. Now, continuing with this, now if you look at the Indian MSME and the digital lending opportunity, and digital lending opportunity is what the classical full stack digital banks would do. Now, the MSMEs are about the second largest employer after agriculture, account for 30% of the GDP. The problem with MSME lending is most MSMEs have inadequate documentation, they're not formalized, lot of lack of availability of data to assess creditworthiness. Consequently, for the classical analog banks, the supply side constraints are limited underwriting capability, low product innovation, and therefore a huge net of MSMEs is outside the formal structure. Now, what has happened post 2016? The India stack, as we know, which has the basis of the Aadhaar and then goes up to the payment bridge system, the lot of data is available for the credit value chain, and also government APIs and the GST filings has forced millions of MSMEs to formalize, and therefore what is available today is data on which credit or risk management or appraising can happen much better, provided the incumbent has the technology and the mindset to do so, which probably is not a natural competence of the classical analog banks, and the digital banks are probably better suited to do that. So therefore the conditions are, to summarize, the conditions right now are ripe for digital lending around three vectors, which is tailored products or innovative products or personalized products, customer acquisition models, and differentiated customer journeys. Right. Now, with that, let us kind of understand the concept of a digital bank. Or a digital bank basically is a bank, it's a full stack bank or a full bank as defined by the Banking Regulation Act or the BR Act of 1949. They can issue deposit, makes loans, and offer full set of services as the Banking Regulation Act empowers them. As the name suggests, however, they will not have a branch infrastructure and completely rely on internet and other channels to deliver their services, and obviously will not have a physical branch banking structure. Now, the what is the inefficiencies of the current banking model that we're trying to kind of bypass? You see, the classical banking model has high cost to income ratio, ranging from anywhere between 41% to 52%, and cost to serve ratios, which makes margins thinner and inefficient to deliver services real time. Their underwriting capabilities are based on classical models and the ability to source data from public APIs to figure out whether a prospective lender is creditworthy is a long process which requires data, often which is not available with the MSME, therefore leads to a natural process of exclusion. And obviously there are limited product innovation, like in financial service, like in most subsectors of financial services. These are products which are created in a product push environment as against a customized environment, which obviously makes it difficult for the MSMEs to be part of the classical banking model, right? Because you need a lot of data, you need to kind of spend time with the bank, and you need to produce data. The KYC process, the onboarding process is often cumbersome. So without a choice, these MSMEs go to the money lenders who are light on the data that is required, but very expensive in terms of the interest that they charge, which obviously, therefore, for the growth of our economy and meeting our $1 trillion digital aspiration, this entire segment needs to be brought under the formal banking or the financial inclusion process, which is called the deepening of financial inclusion. Now, if you look at neobanks or the digital models available. So a neobank is basically a fintech or a challenger bank which offers banking services without a branch infrastructure. Now there are three basic models, which is digital banking units of physical banks who offer banking services through an app. You have the DigiBank of DBS, 811 Kotak, SBI, which are basically an app, an extension of the physical bank. Then, which is point A here, and the point C is a pure OTT model, which most Indian neobanks fall into, where what the fintech does, it's only a customer acquisition engine, and it acquires the customer. The underwriting and everything is done by the bank in the back end, right? So it's basically an API layer which makes it happen, and most neobanks are of this type. So you have the Open, the Neo, the Tide, and so on and so forth. Now, digital only banks are have their own banking license, as I've defined in the previous slide. This is largely a global phenomena, and what we are discussing is the regulatory shift and the model of regulation that needs to come in to make the digital only banks sustainable in the Indian context, right? So moving on, if you look at the neobanks and the value proposition, they serve underserved population, new to bank population through digital accounts. They have differentiated experience for millenniums, Gen zero markup capability. There is an amount of product innovation, and the other thing that is coming up is micro MSME or the Kirana tech, which is mobile first solutions. See this company called Khata Book. Essentially, it works with micro MSMEs, enables it to do invoicing, purchasing, and receivables, keeps an entire account of it on an app, and can predict the credit gap of the small milkman, your kirana store, and that credit gap is fulfilled by the bank in the back end. So it enables a micro MSME to plan his financials better and leads to a flow based lending model. Now if you look at India, digital India, and the government's focus on digital finances, it is actually from a regulatory and from a policy perspective trying to enable flow based lending, which will disrupt the classical banking infrastructure, banking model, which also adds on to the fact that the time for digital lending has truly come, provided the credit appraisal process and the governance around that is managed well. So if you look at the neo banking model, the classical challenges of the model, this is an API based layer. So there are banks in the backend, or the banks who have a banking license in the backend. They have card networks and switches. There is an API layer, and there are services. The services could be in the form of banks, banking services, the classical banking services, cards and payments and KYC, and the front end is the neobank. Now the neobank therefore is just a customer acquisition and an engagement engine, while the underwriting, the capital and everything else has the analog banks in the back end, which now comes up to three basic challenges that the neobanks would have. The first is the limited revenue potential. These are basically fee-based revenues which you can get for customer acquisition, a share of the fee-based revenues that you get, or the fraction of the interchange revenues for payments processed, which is minimal, and these are the only two revenue streams that a neobank has. Now, is this revenue stream good enough to sustain its technology costs, its SEO cost, and the other parts of managing this kind of an infrastructure is something which is a very questionable thing. The second thing is the technology of the partner banks. Now, neobanks will be constrained by the core banking system of the partner banks to be able to engage with digital native businesses, because the core banking structure of the partner banks are a product push environment. Now how they will engage with the digital native customers is going to be a challenge. So the neobank will face a technology challenge, not because it is technology starved itself, but the back-end banks may not have the technology prowess to be able to meet the needs of its customers. The third important thing is that it has a high cost of capital and no entry barrier, which basically means that the neobank by regulation cannot access low cost deposits and have to be reliant on expensive private equity fund to meet its expenses. Consequently, there are no entry barriers, and therefore that makes the business model of the neobanks in the long term fairly unsustainable. Now, given these three challenges, is neobank going to enable the credit gap management problem? Probably not, and therefore there is an important need of creating an alternative low cost model of banking premised on technology, and that is the underlying theory on which the full stack digital banks are coming to play. Now, the regulatory framework which is suggested by Niti Aayog is to introduce a restricted digital bank license where the paid up capital is limited and is proportionate to the restrictions that are in the first phase of this restricted license, and you need to have a capital of 200 crores, and at the end of it, when you give full stack services, it can go up to 200 crores. So it starts with 20 crores and can go up to 200 crore. The track record and potential application pool, the people who would be probably considered for a digital bank, full stack digital bank license, need to have a track record not purely in banking but in engaging in digital native businesses, where controlling persons would have to have a proven track record in either e-commerce, payments tech, cloud computing, or anywhere where there is technology rich capabilities. Right, neobanks can obviously also apply to become full stack banks. These banks will be given full infrastructure access, just like traditional banks, which is the government APIs, to be able to pull data, to be able to take underwriting decisions, then the payment process, which is the UPI, IMPS, NEFT, ATM schemes, and so on and so forth. Now, after the application acquires the restricted banking license and commences its digital bank in a sandbox. Now, in the sandbox, it has to work for a number of months or years, depending on which needs to be decided. And as you perform in the regulatory sandbox and prove yourself or your worth, your relaxations on operations would be reduced in a phased manner to the final stage, where contingent to satisfactory performance of the licensee in the sandbox, the set of restrictions would be removed, relaxed, and the advance of digital, and you would advance to a full stack digital bank with a bank license. Now that comes back to so to summarize, we talking about a couple of important things. The credit gap in India needs to be addressed, and it cannot be addressed in a way that Nachiket More committee visualized it by opening narrow specialized banks. You have to make a big movement to open up banking to a larger set of people and also enable these people to get access to low cost fund. So the strategic moat that classical banks have, which is the banking license premium, needs to be challenged. That's number one. Second is the low cost banking model has to be evolved, and a product innovation needs to come in. So the classical banks are product push environments like the classical insurance companies. Now you have to personalize your products to digital native customers, and to be able to do so, you should have a technology rich environment, which hopefully the digital banks would create. The third is the cost of infrastructure has to move from the branch banking infrastructure, where it takes 3 to 4 years for a single branch to break even with revenues, to a technology infrastructure, and therefore the cost to serve, hopefully the cost to serve and the cost to income ratio would be favorable, and that would enable them to give cheaper credit and wider spread credit amongst India's digital native populations, the micro MSMEs, and so on and so forth. The hope and prayer here is that while the small finance banks and the payment banks made some impact on the credit process, the digital full stack digital banks will have a significant impact on extending credit and bringing in micro MSMEs into the formal credit process. Thereby that extension of credit will lead to a change in the household debt to GDP ratios and would fuel growth. So therefore the digital banks, from a strategic India competitiveness perspective, is a key lever. However, till certain digital banks go through the sandbox process, we don't know how this will play out. However, the India's demographics and the technology parameters are hopefully going to sustain these banks over a period of time. And that's the hope and prayer. If you guys like the video, do share, comment as you deem fit. Look forward to other videos in this channel, and thank you for watching. Have a good day.